this is what we discussed on Monday. I want to quickly wrap through that or go through that. Then we will use that as a guinea pig to, use the principles here to be able to solve the questions, because accounting standard is about understanding the principles. If you understand the principles, you can solve any question relating to the financial instrument. So stay with me. So we are starting with IFRS 9. Now, on Wednesday, we discussed briefly that a financial instrument is any transaction that one party will recognize a financial asset, then another party will recognize either a financial liability or equity instrument. But we ask ourselves, the party that will recognize equity or financial liability, how do we recognize that? Then we said there is a golden rule question. The golden rule question was that, does the entity have an obligation to repay? So if an entity issued, an entity raised finance, does it have an obligation to repay? If the answer is no, they don't have any obligation to repay, then we have to recognize equity instruments. However, where the entity have an obligation to repay, then we have to recognize what? A liability. Then I told you that there are a couple of terminologies that we must understand and know which party's book we are preparing the financial statement in. So we said, anytime you hear something like sold, issued, raised finance, then you have to be thinking around the issue relating to financial liability or equity instrument if we are dealing with the books of the company that did the issue. But anytime you hear things like bought, purchased, acquired, then it means that we are dealing with a financial asset, because the entity that bought the item will be recognizing a financial asset in its books. Then we said, when it comes to financial assets, it depends on the way the entity is going to be accounting for it. And that is whether it is for trading purposes or for speculative purposes. If it is for trading or speculative purposes, then the transaction cost will be written off in the P&L account. We discussed this. But if it is a part of long-term strategy or the entity is holding to maturity, then what is going to be happening is that the transaction cost will be included in the initial cost of the financial assets in the context of the question. So that was what we discussed as well when it comes to the financial asset. With the financial liability, what we mentioned was that financial liability is recognized at fair value less the transaction cost. That is the initial measurement. Financial liability is recognized at fair value less the transaction cost. That is how we will be able to recognize financial liability. So based on these principles now, let's get excited and solve some questions. And I want you to pay attention carefully, because we are going to be using the questions as the guinea pig, and clues will be available in the question for us to know exactly what is going on. Clues will be available in the question for us to know exactly what is going on, and most importantly, how we can answer the question in that particular case. So let's go. So the first question I want us to look at in this particular discussion is a very simple question. And that is, I think, let's scroll down a little bit. And you can take a screenshot of this particular one here. That is a Saman Kese Limited. You can see it there as a 5-mark question. As a 5-mark question. I want you to pay attention carefully, because the words, financial instrument is not difficult. Accounting standards, it's not difficult. They are not difficult. You need to pay attention and understand the principle and apply it. Remember what I told you earlier, that we are going to be playing with these words: bought, purchased, acquired, sold, issued, and then raised finance. These are the choice of words we are going to be using when it comes to dealing with the financial instrument. So having these at the back of our mind, let's go to the question and let's see what we can do. Look at the requirement. What does it say? It says that in accordance with IFRS 9 financial instruments, how much should be recognized in Asaman Kese's financial statement in respect of the above transaction for the year ended 31st July 2019 to 2 decimal places. Please stay with me carefully. For the year ended 31st July 2019. Now, year ended is very important to us anytime we are dealing with financial statement preparation. So, what do we have here? What we have here is that if the year ended is 31st July, that means the year starts from 1st August. So before we get excited, it is important you understand exactly what is going on there. So let's look at the question. Asamankese Limited purchased. Did you hear that? Purchased. Asamankese Limited purchased. What did I tell you earlier about financial instrument? I said if it is the word purchased, bought, acquired, then we are dealing with what? A financial asset. So quickly, we know that since Asamankese Limited purchased, it means that it is a financial asset. So before we get excited and continue to read, we know this is a financial asset because Asamankese Limited purchased. They purchased. Then we need to read on what did they buy? Did they buy debt instruments or they bought shares? Because remember, back to the principles, everything is principle. If they bought a debt instrument, then we said that it will be carried at amortized cost on subsequent measurement. But then the initial recognition will be based on whether they are holding to maturity or it is for speculative purposes. Principles. So let's go. A 6% 50 million Ghana cedi bond. Okay. So they bought a bond. So it means that is a debt instrument. So if it's a debt instrument, it means that on subsequent measurements, we'll carry it at the amortized cost. I hope you are getting the picture. When did they buy? They bought it on 1st August 2018. That is the beginning of the current year. Because if the year ended is 31st July 2019, then the year started on 1st August 2018. Stay with me carefully. At a 10% discount to par value. So let's begin to get some free marks coming in. Put down the name of the company, Asamankese Limited. Let's look at the initial recognition quickly. So the first thing we do is how much did they pay for the deal? Okay, so we bring in the purchase price. How much they paid for the deal? Go back to the question. It says they bought a 50 million bond, but at a 10% discount to the par value. It means they didn't pay 50 billion. They paid less than that because you see, bond can be issued at a discount or they can be issued at their par value. When bonds are issued at their par value, it means they are issued at their face value. So assuming we are told that they bought the bond on 1st August 2018 at its par value, then it will mean that they paid 50 million Ghana cedi. But in this case, they bought it at a 10% discount to the par value. At a 10% discount to the par value. So technically, they paid 90% of the 50 million. Are you getting the picture? They paid 90% of the 50 million. So 0.9 by 50 million, and that is 45 million. So they paid 45 million for the deal. Okay, for the bond. Now, even though they paid 45 million for the bond, the face value of the bond is still 50 million because interest will be paid on the face value, which is the 50 million, the par value, which is the 50 million. Then let's go. Expenses of purchases were 500,000. Okay. Expenses of purchases were 500,000. Now, that is the transaction cost. Remember, when it comes to financial assets, we said the treatment of the transaction cost depend on whether the financial asset is for trading purposes or if it is hold to maturity or part of the long-term strategy of the entity. So we don't know for now where we have read to. We don't know if it is for trading purposes or it is held to maturity. So let's continue to read. It says that the bond is due for redemption on 31st July 2028 at par. So it will be redeemed at the fair value of 50 million in 2028. The effective annual interest rate to maturity is 7.5%. So there are two things you have to understand. The coupon rate is the face, the interest rate paid every year. Okay, interest paid every year, paid each year. And that is the cash, more or less like cash receipt. In the context of this question, more or less like cash receipt. Okay, the cash that we will receive every year. The effective rate is actually the interest that is supposed to be paid. So the effective rate is the interest payable. If you remember on Monday when we're discussing, I told you that it is the effective rate that will be recognized in the P&L account. And so the effective rate is always higher than the coupon rate. The effective rate is always higher than the coupon rate. So the effective rate is 7%. We'll come back to that. Asamankese intends to hold the bond until its maturity. Wow. So you see that everything is added together. Number one, Asamankese purchased. So it's a financial asset. Number two, they purchase a bond. So it's a debt instrument and must be carried subsequently at amortized cost. Then they incur the transaction cost, but the treatment of the transaction cost depends on whether the purchases was done for trading purposes or for speculative purposes. In this case, we are told that the bond is held to maturity. Now, what did we say we do when the bond is held to maturity? So we said if it is held to maturity, then the transaction cost will be included in the initial cost of the financial asset. Principles. It's not a miracle, it's not a magic, it's principles. So now I'm going to bring in the transaction cost. Okay, so we're going to add transaction cost, and in the question they said 500, and that will be 0.5 since we are working in million up, so 0.5. So now the initial measurement of our financial asset, which is the bond that has been purchased, will be 45.5. Okay, 45.5. That is the initial measurement. Remember, this initial measurement is on the date of the purchase, which is the 1st August. Okay, 1st August 2018. I hope you're getting the picture. 1st August 2018. So on subsequent measurement, which is the year ended at 31st July, this bond will be carried at amortized cost because it is a bond that the company bought at the end of the day. And bond which had no market value are always carried at amortized cost. So carrying amount at 31st July 2019, which is the year ended the examiner said we to prepare. So present the amortized cost. What we do is to bring in the balance brought forward. We bring in the finance income, because remember here we bought. So it's going to be finance income. Then we bring in the interest received generally. Then we bring in the balance brought down at the end of the year. So this is our pro forma, slashing the currency sign in million. Put some respect on the measurable currency, Ghana cedi. So we go. Now remember, the finance income, like I told you, will be the effective interest rate, and that is at 7.5%. The interest received will be on the coupon rate because that is how much you will receive every year, and that is the 6% coupon rate. 6% coupon rate. Okay, so let's bring in the figure for the period under review. So for the year ended 31st July 2019, we bring in the initial measurement 45.50. And remember, interests are usually paid in arrears. Okay. So we apply the finance income on the 45.50, 0.07. What's the rate? The rate is 7.3, not 7.5. Let me put that down well. 7.3. So I am getting 3.3. Remember, the examiner said we should work to 2 decimal places. So you have to be mindful of that as well. And that'll be 3.32 probably. So that is the interest income. This is what will go to the P&L account. Then the interest received will be on the coupon rate, which is the 50% in that particular case. So 0.06 by 50, which is 3. So the interest we receive is 3, and that is on the coupon. Okay, that's on the coupon. I want to just show you that here. So annual interest that we receive will be on the coupon rate. So that'll be 6% on the nominal value of the bond, 50 million. And so every year we'll receive 3. But in actual sense, because of the fact that there is an effective rate, they are supposed to have given us 3.32. So what will happen is that the extra, 32 and 0.32 will build up. Then by the date of redemption, it will come back to the 50 million that we are going to be receiving. So let's do the arithmetics. 45.5 plus 3.32 minus 3, and that is giving me an amount of 45.82, possibly 45.82. Please, we don't split anything between current and non-current. We are done. That's all. So let's extract financial statements in respect of this question. So profit or loss. Remember, it's an extract for the year ended. For the year ended 31st July 2019. So in the P&L account, what will come there? What will come there will be the finance income, because the effective interest rate is what comes to the P&L account. This is what goes to the P&L account. Be careful, because sometimes if we are solving questions and it is a redraft financial statement and we are correcting, what will happen is that probably the entity might have recorded the interest received rather in P&L. In that case, only the excess amount, the 0.32, that will add back to the P&L account. So you have to be mindful of the context of the question when it comes to the preparation of the financial statement generally. You have to be mindful of the context of the question when it comes to the preparation of the financial statement generally. But here it's an extract. So all we do is to bring, the finance income coming in, which is the effective rate. So we bring in the finance income. How much we got? That was 3.32. So we bring it in. 3.32. We bring it in. And that's an inflow. And it's an extract as well. That's the only figure going there. So we can leave it like that. Then we go to the statement of financial position, also an extract. Statement of financial position. Let's see what we have. As at 31st July 2019, also an extract. And it's a financial asset. Okay, they bought an instrument, so it's a financial asset. So, and they are holding on it to maturity. So it will be as part of their non-current assets. So you have to be careful, because even though it's a debt instrument they are buying, it's not a liability. They are buying it. As far as they are buying, it's an asset. So non-current assets. So under non-current asset, we'll bring in the financial asset, being the carrying amount we got from here, and that is 45.82. 45.82. That is the idea about the way we solve this question.